Taking a look at that chart that I had up just before, of course, that makes sense, right? With these hawkish expectations, you also pull forward these concerns about when they'll need to start easing conditions again. Combining that with the flattening curve, is there a legitimate concern of a policy misstep here?
Well, there absolutely is. And one of the biggest challenges of the Fed is they themselves, I believe in their heart of hearts, truly believe that inflation is transitory in nature. But the challenge is it's no longer a transitory or willing to call it transitory because inflation's become a true political concern for the Fed. And the Fed is absolutely a political organization whereby Biden has taken away the ability to sit and wait and just watch inflation come down naturally. So the real question into that chart, of course, is do we reach above neutral rate on Fed funds rates before inflation proves to be transitory? And I think that's the big concern that markets are watching, is that as the Federal Reserve becomes more hawkish themselves, as they are forced to raise rates, that they're ultimately forcing into an already slowing economy. And that brings with it, of course, the slowdown and repricing of earnings looking forward.
So in this uncertain environment, where are you finding opportunities? It's funny, we had a previous guest saying it seems like investors are heading, institutionals are heading to China as a safe haven, which is just such an unusual framework to think about.
Well, in fixed income markets in particular, I think the biggest opportunity today is to pare back risk broadly, right? You talked about the potential curve inversion, not just in 2s, 10s, the classic measure, but we've already seen the curve inversion amongst 7s, 10s, which no one really talks about, and we're really close on 5, 10s. And so the cost today to pull back potential volatility and watch from the sidelines, in essence, isn't very high. That's what we at Thornburg are recommending for many investors in our fixed income products in particular, is to remind yourselves what the outcome there is supposed to be. And bond funds are meant to be preservation of capital. They're meant to be stability. And there's a lot of opportunity to simply pare back. It doesn't cost you that much in today's environment while the Federal Reserve ultimately gets back on the right sidelines.
You talked about the political nature of the Federal Reserve, which I find really interesting because the markets are now expecting a much faster tightening. In that sense, with the Fed really advocating for transparency, predictability, can it really veer off sharply from what markets are already expecting?
You know, I think that we have to remind ourselves, ultimately central banks will be data dependent. But we also have to remind ourselves that the Fed doesn't have 2 mandates, which we classically talk about. It actually has a 3rd. So we always talk about price stability. We always talk about maximum employment. But congressionally, the Fed has a 3rd mandate, and that's moderate long-term interest rates. You know, it's our belief that the Fed has used this to talk about financial stability, but it's also our belief that they've used this to talk about ensuring that the recovery reaches all levels of the wage spectrum. And one of the things I think markets aren't correctly discounting is that if inflation proves to be less than perfectly transitory, we do think we're in a higher overall level of inflation, but not problematically higher. But if it's as a result of the lower income portion of the population out-earning what has been historical, and that translates into higher sustained inflation, we think the Fed might actually call that good inflation, right? They've systematically undershot their objective for quite some time. I think they're willing to systematically overshoot it. And I think the Fed might surprise by being more patient than perhaps the markets are expecting and stopping at perhaps a slower rate as inflation does prove to come down.
Are markets correctly pricing in what's happening with the Ukraine-Russia tensions, especially as they can really filter through the oil pricing and inflationary concerns as well?
Well, all of these things, they act as a natural brake on the economy, right? As we see commodity prices rise, and that translates into a lower propensity and ability for the consumer to spend on other goods and services. Naturally, it acts as a brake. The challenge, of course, comes in the multitude of tweets, as we've seen today. Nobody knows the timing. But what we do know is if there is a full-scale of invasion of Ukraine, that it'll be incredibly challenging on financial markets, right? We haven't seen a full-scale invasion of this magnitude for many, many decades. And the primary way that we're likely to fight this is through financial sanctions, which will bleed through financial economies, perhaps even more than traditional war.
When it comes to being able to hedge against that kind of risk, Jeff, what would you be advising at this point, given that there's still just a great deal of uncertainty as to how this plays out?
As we watch the market unfold, watching the growth value dynamic in equities is tremendously interesting. I know there was a guest on earlier talking about that. But as we watch, it tends to be that prices file earnings revisions. And the companies that we're still continuing to see revisions out of generally tend to be more of the value-based. And we saw that just with some earnings reports today. So a couple of companies that we like there, we do continue to think that sector has a decent ways to go. But there are some hedges amongst the high multiple stocks as well. So one of the ones that we're watching is CME Group, right, where they act as a natural hedge, where people come in looking at ways to hedge potential volatility. They benefit from this. It filters into their earnings. So we're seeing opportunities there, as well as just focusing on the U.S. consumer that still is benefiting, albeit less so, but continues to benefit from those high COVID stimulus payments.